Hello, everyone. Welcome to the weekly roundup. Today we will cover inflation, interest rates, and market volatility. Hello, Ben.
Hi, Eva.
How's it going?
Beautiful day in Ottawa.
Stay indoors. They said
Yeah,
stay indoors.
yeah, exactly. Yeah, the roads aren't busy, so that's good news.
Yeah, but it's not raining here yet. Maybe later on in the day.
I think so.
Okay. Okay, we're going to start off with inflation. The numbers came in largely in line with expectation, but I mean, these numbers were from before the recent energy disruptions. So what should we expect inflation to look like in the months ahead?
Yeah, it's a good question. I think it's going to likely be higher. Obviously, February last year, which I think we've talked about for a couple of weeks, was pretty hot. February of last year, so this print makes sense that it comes in lower than expected, or sorry, in line effectively, which was lower than last year. But as for what's it going to look like in March, and prices have been volatile, that's for sure. So on the energy side, we're seeing them higher, but the cost at the pumps for Canadians, it has gone up, but today it was, 136 versus 156 a couple of days ago per liter. So there's been lots of volatility around that. So I'd say it'd be interesting to see where we finish by the end of the month. But so far, energy prices are higher. I mean, the consumer is stretched and pressed, and yesterday we saw Go Easy come out with a big write-down. Go Easy is a lender in Canada. One of their businesses is called Lending Tree, I believe, and it's on the higher risk scale, more of the subprime. So they took a $178 million write-down and stopped their dividend and so there is some pressure on the consumer as well. So in some cases where we're going to get some pressure up on the energy side of things, I think we are seeing some other downside pressure, deflationary pressures as well, and also the consumer stretch. So I think it's going to be a real tough spot for central bankers, central planners, as what to do if we get this inflation impulse.
Okay. So as Kevin Warsh prepares to take over the Fed, if inflation stays sticky while the job market weakens, what is his most likely move?
It's a great question, and I think it's going to be interesting to see how he progresses, and what he does. I think if it's a Powell in that job, I think we get what we've got now for the last 2 years, which is he's scared of inflation. And so I think we would have had Powell do that, which is stay tight, let the economy deteriorate further before they cut rates. Warsh, I don't know enough about, but based on his past history, you would think he would lean towards potentially keeping rates a little bit tighter. But, I think there's some thinking around that he would cut first before he did asset buying. And so I think, if the economy continues to deteriorate, unemployment continues to rise, I'd say there's a higher probability of a cut than him buying bonds into the market, the quantitative easing. I think that would be maybe later. So I'd lean towards the likelihood is if he gets into that position and the economy is getting worse, that you could see an increase in talk and chatter about interest rate cuts.
Okay, so markets have been swinging all week. Are investors finally reacting to real risks, or is this some short-term positioning like always?
The market's been resilient. It really has, with the exception of South Korea. South Korea is down, I don't know, 25% or something like that. And that's kind of the makeup of this. The South Korean market is something like 70-80% retail versus institutional, which is opposite to what North America would be, which would be 70-80% institutional versus retail. So it's been quite resilient. And we dropped 2, 3, 4, 5%, which obviously is a big dollar value because the size of North American markets, but it's been quite resilient. And I think it's because of the so many cross currents, to your point. Maybe some inflation uptick. We're seeing unemployment rising. We're seeing, so yields are starting to move, and then the US dollar is moving, and then gold doesn't know what to do. It's been up and down $200. And oil, obviously, the futures contract, which I know you and I talked about this week, that I think that the futures market or the oil market that everyone's watching is skewed out and not necessarily a reflection to what's actually happening to oil. So, the market's been resilient. There's been a few pockets where things have been hit, but nothing material. Go Easy was the standout, which was down 50% yesterday, but that was not symptomatic of what's going on in the world.
Almost like they don't care.
It's almost like they don't care. Yes. Yes. It's been very muted, and I guess the world still thinks that he'll be able to walk away from this, and Trump will be able to walk away from this. Obviously, lots going on still in Iran and the rest of the Middle East, but so I think the market's been is resilient given the chaos.
Okay, I see the charts.
All right, so we are recording this on Wednesday, March 11th, recording the day early, and give you an update on what's going on today. It's about 1 o'clock, so lots continues to be on the go as I look through and try to find different things. We're going to cover, I'd say, bond issuance. So this is federal crown bond volumes have shot higher. So this is Canada. And so, lots going on. I'd say Canada. Carney certainly has been traveling the world, setting up, trying to work on relationships in the different countries and seems to be having some success. But we've seen a huge uptick in bond trading in the first quarter so far, and we're not even done the first quarter yet. Interesting note that CMB, so this is mortgage bond issuance, 10 years, or increased by 165%, which is something that tweaked my interest a bit. So if there was an issuance at that level, maybe the government's starting to think maybe we should issue at longer duration. And they like where the rates are at that point. So I think that'll be interesting to watch. But bond issuance uptick and trading uptick in Canadian crown corporations. So that'll be something to watch as and if you are interested about our deficit levels and bond issuance. Another one that grabbed my attention, this is ESG Image of the Week, so corporate clean energy. So we have an investment team that follows the clean energy market. Quite interesting research they put out. But I thought this was a great breakdown just to see that there is still clean energy issuance happening in the world. And we're looking at 2024. We certainly peaked with Asia Pac, Americas, and then Europe, Middle East, and Africa. So still high levels, and I do think we'll continue to see more attention towards this. There's a lot more positive news heading in this direction. Energy supply is a key piece that I think plays a role for the next 10, 15, 20 years as AI and technology and efficiencies start to take over. So this will be important to watch. And I think an area that's still underappreciated. And I think there's opportunities to buy some stocks in this part of the market. But I thought this was great to see. Did fall off a little bit, but still positive direction happening. The last one, which is a bit of part of our conversation at the top, this is from our partners at ISI Evercore. Good news, bad news chart, which is great. So good news, Eurozone jobless is positive. Australian economy on track. Asian manufacturing shows resilience. And so obviously you'd have to trust all these numbers, but certainly some good things in the win column on the good news side of things. On the bad news side of things, there is, to your point, jobs, 92,000 jobs lost, and unexpected downturn. So yes, they're expecting job growth, and we saw a job loss in the US. If that continues, that is quite bad news for President Trump and the central planners. So that'll be worth watching. China signals new era of slower economic growth. I mean, I think that's something that we've always been aware of, that they would slow down as the economy evolves and develops. So I don't think that's a huge surprise, but that certainly is in the bad news column. And Iran conflict boosting gasoline prices. So since most of the developed economies are very reliant on consumption, that's a major tax. So I think that's an important one to pay attention to. And to your point around inflation, I think the two of those things are important and key to watch for what happens to the economies from this point. And I think that that will be a key piece to watch. But as always, we're trying to look ahead, and sometimes when the market overreacts one way, it gives you opportunities to be positioned for what could potentially happen in the other direction. As always, the opinions expressed do not necessarily reflect those of National Bank Financial. I prepared this in the best of my abilities. Everyone has their own risk tolerances. Should you have any questions, please reach out to Eva or I, and I'm happy to address anything that you're looking for. But yeah, please consult your risk tolerance at all times.
Thank you, Ben.
Welcome.
So what's on the agenda for next week?
So we have some central bank announcements next week. 18th, I believe, is next Wednesday. We'll see rate decisions. Right now, it looks like no change. So we'd be watching that. I think we'd be watching it more from the perspective of what are they saying. And the obviously the press conference from the U.S. Central Bank, because they do a full presser afterwards, is always worth listening to, seeing where they think there's potential risks and or deterioration. Bank of Canada as well. We don't tend to get much feedback about what they say until a month from now. So we'll be looking at last month's information as that comes out. So I'd say those pieces, and European Central Bank is on Thursday next week. So those are three kind of key points that I'd be listening and watching to. Of course, the conflict in Iran will hover until it doesn't. So that'll be an important piece too.
Super. Thank you, everyone. Remember to visit, subscribe, and follow us on YouTube and LinkedIn at Hart Investment Group. The link to our daily financial heartbeats will be in the caption of this video and in your email box if you're subscribed. For our clients, please reach out to me if you have any questions or if you'd like to book a review meeting with Ben. Thank you once again for listening and enjoy the rest of your day. Bye.
Thanks, everybody. Take care.